video, I will tell you about the 3 main tools for market analysis that you will need once and for all. No more patterns and unnecessary clutter that only hinder and bring failures. I am sure you have not seen anything like this before. Let's get started. As we already know, the logic of the market is very simple. It is based on 3 main elements: liquidity, volume, and inefficiency. Any movement can be described using just these 3 concepts. At the top of this chain is liquidity, which is the sole driver of the market. Without liquidity, that is, without buy or sell orders, the market simply would not move. It is important to understand that any element on the chart can provide liquidity, but the question is in the quantity. The second most important element, the foundation of all our market logic and strategy, is volume, which directly reflects the amount of liquidity entering the market. In other words, how much money has entered the market. And the third element is inefficiencies, which are formed as a result of the influence of volume on price. They are graphical representations of volume at a specific moment in time, depending on the time frame. Inefficiencies will be our tools through which we will look at the chart and do our analysis. To understand the deep logic of inefficiencies and market movements, we need to consider 2 main factors. The first factor is the state of the market at a certain point in time. It can be of 2 types, balanced or unbalanced. What does this mean? When the market is in a balanced state, the volume of buys and the volume of sells are equivalent to each other, and the price hardly moves. In other words, neither buyers nor sellers dominate the market. This is very rare, and mostly happens on days with very low volatility. The second type is the unbalanced state, which is more typical for any market. This occurs when the buy volume is greater than the sell volume, and the price rises, or when the sell volume is greater than the buy volume, and the price falls. We have sorted this out. The second factor is the efficiency of price delivery, which also comes in 2 types. The first type is called efficient delivery, because in the context of a certain market movement, there are both buyers and sellers present, allowing for a more even exchange of assets. It is important to consider that price delivery is always an unbalanced process in which one side, either buyers or sellers, dominates. The second type is inefficient price delivery, which implies that the exchange of assets occurs unevenly in certain price ranges between buyers and sellers. This means that there are places in the market where orders remain unexecuted or only partially filled, which is a key sign of inefficient pricing. You may have noticed that inefficient price delivery is similar to the fair value gap, which we will discuss next because it is the first and simplest tool we use. The fair value gap is a price action element formed by 3 candles, where the high of the first candle does not cover the low of the third candle in a bullish scenario, and the low of the first candle does not cover the high of the third candle in a bearish scenario. The logic behind this tool implies an impulsive price reaction to zones of liquidity or inefficiency due to a surge of a large amount of liquidity into the market, which we also refer to as volume for buying or selling. This leads to an uneven exchange of assets between the parties. When a bullish fair value gap forms on the chart, the range where the wicks of the candles do not overlap indicates a lack of participants who were ready to sell as much as buyers were ready to buy. In other words, there was not enough selling volume to absorb the buying volume, resulting in unfilled buy orders. Conversely, when a bearish fair value gap forms on the chart, it means there was not enough buying volume to absorb the selling volume in that range, leading to unfilled sell orders. This is the main reason why, when these zones are tested, the price often reacts and reverses in the opposite direction. When the highs and lows of the candles overlap, we cannot assert that a fair value gap has formed, meaning the exchange of assets between buyers and sellers was much more efficient, hence the name fair value. Now let's talk about FVG levels and the price reaction from them. Basically, we have the upper and lower boundaries of the fair value gap, but the 0.5 level is often marked as well, which is considered quite strong, and ideally, the price should bounce off it. Therefore, it can also be used as an entry point for a position. As for the validity of the FVG when it is tested, it is quite complex because much depends on timing. However, in my opinion, the main thing is that the price does not close below the lower boundary when the FVG is bullish and does not close above the upper boundary when the FVG is bearish. This would be considered an inverted fair value gap, which may indicate a continuation of the movement. Everything else is permissible, but again, much depends on the context. Let's look at a couple of examples on a real chart, and then move on to the next tool. A fairly simple example of a fair value gap, FVG, is as follows. The price performs a liquidity raid, after which very aggressive buying volume enters the market, forming two FVG zones. The price tests the first zone but does not receive enough volume to continue moving further. Then the second, lower zone is tested, from which a rejection block is formed, and the price continues to move in the direction of the trend. In the given context, on a one-day time frame, two fair value gap zones have formed. We can clearly see that each zone, after being tested on the chart, forms a new one, and the price never closes above these zones. This means that the fair value gap has enough strength to cause the price to reverse and move in the opposite direction. An order block is a price action element representing a price range where the highest volume was traded, often formed manipulatively. Forget the assertion that an order block is the last candle before a reversal. This has no logical basis. First, let's note the two types of levels that form in the market for a full understanding of this tool: support and resistance. A resistance level is formed when there are two candles, the first being a buy candle and the second a sell candle. Where the first candle closes and the second candle opens is our resistance level. A support level, in turn, is a formation where the first candle is a sell candle and the second is a buy candle. Where the first candle closes and the second opens is our support level. Based on basic logic, these levels represent points where the balance between buyers and sellers shifted. This gives us reason to believe that large players opened or closed their positions there. Therefore, there is a chance that when these levels are tested, additional buy or sell volume may enter the market, with large players buying or selling in these spots again. It is believed that in this way, they can protect their previously open positions. How is the order block zone formed? The order block zone implies a breakout of the resistance level, buy plus sell candles, and a close above it for a bullish order block, and a breakout of the support zone, sell plus buy candles, and a close below it for a bearish order block. Let's imagine we have a zone of liquidity or inefficiency. For the price to reach this zone, there must be sell volume in the market pushing the price downward. This means that someone interested in this movement must open a short position. Upon reaching the zone of interest, two entirely different processes occur with the same identical outcome. The price impulsively moves up. Why does this happen? We already covered part of this logic in the previous video, but I'll quickly recap. When there is a liquidity zone, it means that stop losses of players who previously opened their positions are likely located behind a certain fractal. Thus, this zone is of interest to a large player, because there are those ready to buy or sell a lot. They actively exploit this. This logic works the same way here. The price tests the liquidity zone, activating the stop losses of players who previously opened long positions. These are sell orders or sell-side liquidity, but at the same time, the large players' buy orders are activated, allowing them to accumulate a large portion of their position here. Thus, the sell orders acted as counter-liquidity for the buy orders. The reason the price moves up impulsively is that the volume with which the large player operates significantly exceeds the volume of everyone else combined. When the price tests an inefficiency zone like a fair value gap, it gets the primary buy volume due to unfilled orders, often leading to a reversal in the opposite direction. It's quite possible that these unfilled orders belong to the same large player who wants to fill them, providing an opportunity to accumulate their position at lower prices. This is why I believe that the order block mainly has a manipulative formation mechanism. The same logic works in reverse for a bearish order block. Again, the question arises, why does the price react when testing the order block zone? There are three main reasons why this might happen. The first and most fundamental reason is that the positions initially opened to push the price down and form the resistance level may still be open, and even in a loss. Therefore, it is not profitable for the large player to hold them if the anticipated price delivery will proceed upward. When the price tests roughly the first half of the order block, short positions are closed through buy orders, creating buy volume that pushes the price up. This can also happen at the moment of breaking the resistance or support level, provoking an even larger impulse. The second reason an order block might react is the same unfilled orders after testing and the surge of liquidity into the market. The third reason is quite interesting and has logic similar to support and resistance zones. An order block is itself a zone where the balance between buyers and sellers changed, or vice versa, which also draws interest for additional position accumulation or distribution. Often, if you look at the order block from a higher time frame, you can see that it looks like a rejection block, which we will discuss later. Let's look at several examples on a real chart. A classic example of how a bullish order block can appear. The price tests a bearish fair value gap, from which it receives selling volume, pushing the price down with the purpose of rebalancing the bullish FVG and conducting a liquidity raid on the equal lows. In this area, buying volume enters the market, pushing the price back up, breaking through the resistance level, and closing the candle with a body that forms the order block zone. This zone is then tested, and the price reacts accordingly. It is also important to note if an FVG is formed in the order block zone on the same time frame or a lower one, as this provides additional confirmation of its strength. Additionally, we can see a bearish order block, breaking through the support level, then testing it, and continuing the downward movement. If you observe closely, every market movement is interconnected. Sell or buy orders from one instrument are used to create another, and so on. Therefore, one should never forget the from zone to zone rule, which somewhat describes this logic. The price always moves from one zone of interest to another, from liquidity to inefficiency and vice versa, or from internal liquidity to external liquidity and vice versa. The third and final tool is the rejection block. Its logic of operation is absolutely no different from an order block, but the formation of this tool heavily depends on the time frame from which you are observing and the timing of candle openings and closings. Similarly, there is a change in balance between market participants, and whether you are looking at a support or resistance level, an order block, or a rejection block, it is essentially the same concept, but displayed differently depending on the time frame you are viewing on the chart. Let's understand how to identify a rejection block. First, a rejection block consists of two candles, where our area of interest will be the range of the wicks of both candles. It does not matter which wick is longer or shorter. If there is only one candle with a long wick, this is considered a simple rejection and an indication of volume entering the market. There is a probability that the subsequent candle will just continue the movement. Secondly, it is important for the wick of the candle to sweep liquidity or rebalance inefficiency. However, sometimes a rejection block closes within the area of interest. This is also acceptable and can be used because it does not invalidate the logic of the tool. Let's look at a couple of examples on the chart. This is a rejection block formed on a one-day time frame. If we mark this zone and then switch to the 4-hour time frame, we can observe approximately the same area as the order block. Another example on the one-day time frame, but this time with a bearish rejection block. If we switch to the 4-hour time frame, we again see that it resembles an order block zone. Here the rejection block is on the 1-week time frame. If we switch to a smaller time frame, in our case 1 day, we see the exact same order block zone. Let's make a final conclusion and put an end to the question of inefficiencies. Any inefficiency on the chart represents areas where orders were left unfilled or partially filled by market participants in the context of price movement, regardless of the reason behind it. If you wonder why fractals are not considered inefficiencies, the answer is straightforward. Orders behind fractals are a phenomenon that manifests post facto, not during price delivery. In the end, we have the fair value gap is an unbalanced and inefficient element in the market due to unfilled orders for opening positions. Similarly, the order block is an unbalanced and inefficient element in the market due to unfilled orders for closing positions. It's important here to conduct your own analysis to understand this. You may not necessarily agree with my opinion in order to be a profitable trader. If this video was useful, don't forget to subscribe to the channel, like, and leave a comment.